Hello, welcome again. I am your host, Innocent. So we are still talking about the CRDB's medium net not program, the Kijan bond, and we have covered several sessions about some of the details that are covered in the information memorandum. And so this is a continuation on the series of the content with reference to, regarding the information memorandum that have been circulated. And today, really, we are going to talk about finances, and then we'll revisit a little bit the the first tranche that is being that is active right now, and then of course definitely we will cover a little bit about valuation, and then other supplementary information regarding this bond. Just to remind you, so we have covered one, the general introduction about the bond. We have covered about the benefits of investing this particular bond, and specifically in this the existing tranche. And we covered about the terms and conditions about the bond. We have covered about risks regarding this particular bond. We have covered information around subscription, how actually going to participate in this particular bond, and specifically, of course, on the existing tranche. And we did take a look as well on the issuer. We did a dig on CRDB. What is CRDB? Who's CRDB? What do they do? And so on and so forth. So one particular element that we didn't cover yesterday with regard to CRDB is the financials. So we didn't talk about the financials at all, and therefore feel today, or as I see that today, it's very important to recover about financials. Now, of course, we want to go into the bigger details of the financials and stuff like that, but then I think it's very, very important to understand, what has been happening financially, the issuer. Yeah, let's get into it. So starting off with the financials here. So by the end of 2022, so the audit financial statements of CRDB shows that they generated an interest income of $965 billion. And they had a net interest income of 745 billion shillings. So these numbers are in shillings, sorry, so not in dollars. And then the non-interest income net of related expenses for 306 billion shillings, and the operating expenses were 554 billion shillings, and of course the income after tax was 51 billion shillings. Now, compared to 2021, there was a significant increase. So you can see that the interest income increased by 22%. This is a double-digit increase. Pretty much every element here increased by double digits. So, interest income increased by 22% from 21 to 22, and the interest expense, of course, increased by 54%, which is not good because it's almost double in terms of percentage points, increased more than twice actually. And then, of course, net interest income increased by 50%. There you can see the effect of more than double increase in percentage points of interest expense over interest income, because you can see the increase in net interest income is actually 15%, which is lower than the increase in interest income. But generally, net profits increased by 31%. So that is a very, very good, very, very good increase in terms of our performance. So this is just the chart of the trend for the 2 years. So nothing new there. So let's take a look on the the balance sheet. So how did balance sheet actually change? You can see that through the loans, the key asset of the bank were 6.8 trillion shillings, uh, which was a 6% increase from 5 trillion shillings from 2021. And customer deposits were 88 trillion shillings, and vis-a-vis 6.4 trillion shillings, which was an increase of 26%. And total assets were 11 trillion shillings, vis-a-vis 8 trillion shillings that was recorded in 21. Now, there isn't something that you need to really understand here. CRDB was the first bank to actually cross the 10 trillion shilling total assets. So that is a great feat, a great achievement for the bank. So in terms of assets, really, the bank is quite well, sitting on a massive amount of assets right now. So in terms of long-term deposit, long-term debt, so the bank reported 491 billion shillings against 107 billion shillings, which was an increase of 148%. A huge increase, but again, I think the loans that the CRDB has received so far have been directed to specific sectors or specific purposes, and therefore they don't seem to be creating a very big strain on its income statement. But I think, as you have noted, that there was a substantial increase in interest expense. So as a result of this 148% jump. So in terms of absolute numbers, it's not like a big deal, but then of course on percentage point, this is a very huge increase. So total liabilities so increased from 7 trillion in 2021 to 10 trillion, which was I think 4% increase. And shareholders' equity increased by 21% from 1.2 trillion shillings to 1.4, almost 1.5 trillion shillings. So you can see also the operating cash flows increased, from 1 trillion shillings to 1.2 trillion shillings, which is very, very good. And in terms of investments in fixed assets, you can see that there was an increase of, there was a decrease actually of 2%. So these are the financials really, and what you have here. What you have here is basically the charts of of these financials. Yeah, so you can see. So basically, I would say financially, the bank has been doing quite well. After a little bit of a struggle in 2016, 2017, 2018, and then the bank has stabilized these financials quite well, and it's one of the very few banks that have really generated interest income, that is have generated income that is beyond is beyond 1 trillion shillings. So then that is really very, very good. Yeah, so those are the key important financials, but then it's very, very important we take a look at the ratios, key ratios. The bank, as I think most of the ratios for the bank are still show that the bank is quite strong. And as you can see, and by the way, these are the ratios as reported by the reporting accountant. And so the key ratios that have been picked out: earnings before interest and taxes, to interest expenses. So the interest cover. So the interest cover is more than one. So the interest cover is more than one. You can say the institution or the company is quite well. So they have cash that they are generating profit that they can use to actually pay for interest expense, and the direction has been quite really well. It was 2.99 in 2020, and then 23.68 in 2021, and then kind of regressed a little bit to 3.25 in 2022. Then operating cash flows to total debt percentage. So you can see, so that was and free cash flow to total debt, repayment cover, it will change to the negative territory in 2022, but not substantially higher to indicate that the bank wouldn't be able to service that. So total cash flows to total debt obligations, you can see that it's 12.2%. It's more than halved, from 2021, and that is really not good. And I think that is one of the areas the bank and that will be improving on to ensure that the bank is sufficiently liquid to honor all its obligations. So net profit margin, very good. It's been going up quite well, from 20.43%, in 2020 to 29.2%, 29% in 2021, and then of course almost 52% in 2022. So that the trend is actually very, very good. So for tax return before financing on employed, so this is basically return on assets. So you can see has been going up as well, and that indicates that it's very, very good. Long-term debt to capital employed. So it was 0.22%, 0.22 in 2020, and then 0.15 in 21, and then 0.20. So the direction has been quite in both directions. I mean, the direction has been quite up and down, but we're still within reasonable levels. So total debt to equity, so debt to equity ratio. Now, this is a financial institution, so it's reasonable for it to have substantial leverage. And I think as long as the leverage is still below 10, I think it's still very, very good. You would expect that total liabilities for a financial institution is quite high in comparison to equity. It's reasonable. 6.43%. I think the bank still has a substantial room to kind of finance its assets. And then free cash flow to debt repayment cover, well, it went a little bit down in 2021, and then regressed back up to 0.94%. Now, of course, obviously, free cash flow, measured against repayment cover is one of the measures of how liquid the financial, or how liquid the company is. But definitely, it indicates that when regressing in the positive territory indicates that the bank, understand that having a free cash flow to actually service, the debt is quite well. Now, when it comes to debt service, we mostly just look at earning the debt, the earnings cover, and we seem to be, and the bank seems to be doing quite a nice job. So generally, the bank is performing quite well on most of some of the key ratios, and that is very good. And therefore, the bank does have substantial financial strength to carry on its debt for the foreseeable future. Thank you very much. I'll be happy to to provide you with more details with regard to this. But I hope that this is going to be helpful to you. Thank you.